Imagine an ocean full of information, having all the answers to your future, where we could fish out what we want. And a super brain called Mr. Sage doing it all. What if Mr. Sage met the wealthiest person on earth, Mr. Money? It could change lives forever, where things happen as we think or even before. Things happen much faster, more accurate, more secure and transparent, where life is fair and far too evolved. And everything you need to know has already been done for you. Finding a solution for your specific problem every time, or doing all the complicated calculations for your finances. A world where Mr. Sage is omnipresent. But how safe would that be? If devices knew what you wanted and delivered results with destructive consequences? What about hackers? Cybercrime could jeopardize the safety of critical information and data, ultimately stealing money from you. But fortunately, humans have always been a step ahead. Having the power to plan for a better tomorrow while in the race for a safer today. The power to create, recreate, rectify, and eliminate. Imagine floating over this ocean of answers with the combined powers of Mr. Money and Mr. Sage. What would that day look like? A dream, a story, or a changed future forever?
So, you just witnessed a short animated film that we specially put together for this year's Future of Money in Geneva. We were actually delivered this film yesterday in the morning, and I can tell you I was extremely nervous because I hadn't actually seen the final cut till then. This film was hand-drawn by a group of talented artists in India. So this is no CGI, this is real old-school craftsmanship, and I really hoped you enjoyed it. So firstly, let me welcome you all back to the Future of Money for the first time on the plenary stage. As some of you may know, the Future of Money has been going on since Sibos in Toronto 2011. And I'm really proud, along with the InnoTribe team, to bring it for the first time to this stage. In past years, it's been standing room only. I hope today everybody found a seat. It looks like you did. So welcome. So I wanted to open with this film because I hope it really illustrates what we want to talk about today, the next big disruptive force for financial services. The Internet of Things is the network of physical devices, vehicles, buildings, and other items embedded with electronics, software, sensors, actuators, and network connectivity that enable these objects to collect and exchange data. Our hero, Mr. Sage, is the brain behind the Internet of Things, taking in sensor data and making sense of it at a very personal level for you, the user. But of course, in order to actually do things, he needs to access our other hero, Mr. Money, or it could be Mrs. Money, by the way. Together, they can start to organize our lives in ways that we would wish to live, so as to simplify those mundane tasks that we're really not interested in doing or that we need to constantly think of. For example, in this scene, our protagonist gets hungry on a journey on the way to the office. In his mind, he orders a burger, which his cranial sensor picks up. Mr. Sage then automatically puts in an order to the nearest burger delivery service. Mr. Money authorizes that payment for the meal, and hey presto, a drone delivers his meal. One very happy customer. However, in order for the efficiencies of this connected system and the Internet of Things to operate properly, a well-functioning, secure micropayment system will become extremely important. Of course, now we're becoming very familiar with wearable devices such as the Apple Watch and others. Not only have these sophisticated sensors built in that that track location, heart rate, speed, and many other factors, but they also are informative to provide real-time user feedback. A number of these different aspects are expected to change around data with relation to financial services. The way we think about risk, for example, will fundamentally change as a result of the availability of very granular data connected to these kinds of devices. For example, if you think about it, the data collected from smart wearable devices can be very useful in redefining risk models for life insurers. But think about this. What if this data results in having people excluded because they're extremely high risk? Who will actually end up insuring that part of the tail? These are fundamental questions we need to start thinking about. And of course, this personal data can become both useful and sometimes problematic. Here, in this scene, our protagonist is reading up on the person he's about to meet. Today, we do this by doing a Google search on other people. But we have absolutely no control about what that system says about us. We could imagine a future, though, where we tightly control our own data and make it selectively available to either people or services that we want it to reach. However, to do this, we have to collectively agree who actually owns this personal data. Is it the individual? Is it the person? Is it the firm who collected that data? These are big fundamental questions. With cars, for example, sensors and the Internet of Things can drive telematics. The basic idea of telematics is that auto insurance can be driven by the driver's behavior in real time. So basically, if a person drives well, his insurance premiums go down. If he doesn't drive so well, his insurance premiums goes up. The insurance company can actually assess the risk of that driver having an accident in real time and change premiums accordingly. So this is already actually a reality. And as we think about the future, we're also very familiar with smartphones. So I would hazard, I'm pretty much sure, that every single person in this room has a smartphone. As we move into more automated artificial intelligence, our hero, Mr. Sage, coming back to him, would be able to make logical decisions for us. Such as in this scene, our protagonist decides on a whim he wants to go away to Hawaii. Mr. Sage orders the car to the airport. Mr. Sage books the flight and the hotel, all with the help of Mr. Money, who authorizes the payments. And then, of course, there are all those things that we hate, like organizing our own finances, even though we all work in the same sector. But help, of course, is at hand, because the rise of artificial intelligence, with decisions regarding investments, creditworthiness, are becoming the purview of automated systems that use input of highly personalized data. Now, for example, here, robo-advisors are a class of financial advisor that provide financial advice or portfolio management online with minimal human intervention. Here, in this scene, our hero, Mr. Sage, is managing the investment portfolio of our protagonist using an algorithm developed using modern portfolio theory in real time. So, where we end up is a world where there's immense personalization based on vast amounts of data being collected by sensors and network-based artificial intelligence systems. Sounds great, right? Well, maybe not. There are clearly some serious issues around the instability of highly automated systems. When a system is completely automated, positive feedback loops develop, and thereby we create inherently unstable systems. It's important for institutions and all of you around this room to really think through the consequences of this. You need to think about creating enough data point interventions that allow you to manage any sort of positive feedback loop. So here, in this scene, the child is waiting for a 3D printer to print out his toy. But something's going horribly wrong. It seems someone has actually tampered with the design, and the toy actually becomes something much more sinister. So in this case, if a downloadable 3D printable design is hacked, who is then liable for the defective product? Today, in some instances, the credit card issuers are liable for product purchases that turn out to be fraudulent. The issue of security and policing, cyber, is going to become of paramount importance in the future. These criminals have both our heroes in their sights, Mr. Sage and Mr. Money. And as you know, hackers are both creative and persistent. And often they'll succeed by breaking through multiple layers of security. So we need to start thinking about highly resilient and efficient systems around these security systems, which will ultimately prevail. So back to our hero, Mr. Sage. He has all this power in his hands. He represents the interconnectedness of everything at scale and speed. In this Internet of everything, everything talks to everything, and endpoints make their own decisions, powered by sensor-driven data collection, machine learning, and automated decision-making. But he needs protection from adaptive systems like our own immune system that selectively remove these pathogens from the system. In this new world, we will need to rethink the notion of ownership and the definition and management of intellectual property, financial assets, digital assets, rights management, royalties in a fully distributed peer-to-peer world. And how do we regulate a world where all the rules have changed? All of these are important questions for people in this room. So maybe we can get to this utopic future where all of this personal data of an individual can be secure and used for the benefit of our protagonist in the company of Mr. Sage and Mr. Money. So with that introduction, I'm going to invite our first guest to the table, Mr. Carlos Menendez from MasterCard. Hi, Carlos. Nice to see you.
Good to see you, Dave.
Come and have a seat. So before I start to talk to Carlos, I'd like everybody who's going to have one of these voting consoles floating around, and I'm going to ask a question. I'm going to ask it now, and we're going to ask it at the end of the session for you to vote. And the question is, what is more important? Is it data or is it money? So I think once the clock starts, you can vote, and then we can take it from there. Great, so we got 73% in favor of data and 27% in favor of money. Okay, let's keep that in mind as we get towards the end. Okay, so great. So Carlos, welcome to the table.
Thank you.
Maybe as a starting point, can you elaborate on why trust is just so important from your point of view when it comes to protecting data and authenticating payments?
Thank you. It's important to start with trust because, trust is at the heart of both what data and money are. The whole reason money has worked is because there's trust. There's trust that when you show up to a store, your money will be accepted. The merchant trusts that the money you're giving them is not counterfeit, and obviously can be accepted. And you're both trusting that that money is worth saving for the future. But now the concept of money is changing. It's not just about allowing the transaction, it's actually carrying data throughout the full experience. And we see that today in its most basic form for these on-demand cars that validate your identity and who you are and where you're going, be it your home address and the such. That's information about you. But it's important that if this future data money is carrying information all the way, that you have a secure digital identity, and that the elements of the service which are private are also kept private. As this experience evolves, if the data, the money, is not kept secure, it doesn't scale because there's no trust. And trust by consumers is what at the end will drive acceptance of this or not. Today at MasterCard, we're delivering that trust, through protected and available money via global standards and security and privacy. We do that, with cards and EMV chips. You do that through tokenization and phones. The key thing is that as we prepare for the future, we recognize that trust is important. And the work we're doing today with the Internet of Things includes that tokenization standards so that a consumer can use their money and have, at the end, a fair amount of trust in that money, be it across all devices, an object, online, in-app, or in a point-of-sale merchant. What's key is that we're building that trust from day one. We won't be able to maximize both trust, convenience, and security if we're not keeping all that in mind.
And when you think about that, and you think about, you mentioned standards, how important, as we get into the Internet of Things, do you see standards, as part of being core to the architecture?
No, I think standards are very important, because at the end, if there's an Internet of Things, and we see that starting right now, it implies small transactions in many different things, be it your refrigerator, as was shown earlier today, or anything else. If those standards aren't set and interoperable, nobody wants money trapped that can only buy milk. Nobody wants money trapped that can only deliver a taxi. You really need standards across to allow the consumer to access all their money however and whenever they want.
Thanks. Well, thank you, Carlos. Well, let me get our second guest onto the table, John Stein, the founder of Betterment. John, nice to see you.
Nice to see you. Thanks for having me. Before we start, I don't know how many of you know a little bit about Betterment, but I will talk about what we are. Uday, in his introduction, talked about robo-advisors, and Betterment is a robo-advisor, although I think the term is a little bit pejorative, because we do so much to empower the best financial decisions. I'll show you. We start by taking a full view of your finances, your accounts with us and external accounts, and we ask you about your goals, like retirement. And based on those goals, we create portfolios for you. Those portfolios, which I'll show you here, are created with the best ETFs in each asset class. We don't manufacture our own, so we're able to select the best and use fractional shares and multiple tickers in each asset class to tax manage the portfolio for you over time. We also give you advice about your goals. Again, using the retirement example, we'll tell you whether you're on track to that goal or not, and if you're not on track, we'll give you advice about how to get back on track. This is really valuable to most savers, where saving and investing more is more important to your outcomes than, say, what's in the portfolio. We also use behavioral interventions. This is an example I love called Tax Impact Preview. And here we show you what your taxes are going to be before you make a transaction. When we show you that, 75% of investors decide not to make the transaction, which is incredible, because we're saving them taxes and saving them from market timing. Finally, we give you advice about how much to save and what accounts. This is an example from Retire Guide, again, about your retirement in this case. We take in your income, your spouse's income, all of your external assets, your pension, your Social Security, anything that impacts this financial picture, and tell you how much you're likely to want to have in retirement, and then what accounts to open, how much to save, what to put in each, coordinating across those. It is holistic financial planning and management. It's what everyone should have, and until today, very few have had access to. It's smarter, efficient financial management for all. And today we're delivering it for retail customers, for advisors, and for businesses in 401k accounts.
Thanks, John. So this is fascinating. You look at it. I mean, how much of this is actually automated AI? I mean, is there a lot of human intervention on the back end? How do you think about that in the broader context?
When you hear the word robo-advisor, you think entirely automated, which is true. There's a really automated version of our software. All of that, though, is built by the best people in finance. It's a combination of people and technology. And we have live customer support 7 days a week. We have CFPs and advisors on the phone to talk to customers. We'll even refer you to an advisor specialist if you have questions beyond what our internal advisors can answer.
Amazing. OK, let's get our next guest onto the table, and then we'll continue this on. So I'm going to invite Doug Shulman onto the table. Doug's a senior executive vice president at BNY Mellon, and one of the key proponents of innovation there. So really pleased to have you with us, Doug. So maybe just as a starting question, we talked a lot about these issues, and you come from it from a slightly different angle, because I mean, on my left is kind of the retail angle, and you're kind of more the institutional angle. How do you think about this whole? I mean, is it even relevant, the Internet of Things, for the institutional market?
Yeah, we talk about interconnectedness, less about the Internet of Things, but more about interconnectedness, which is very similar. And we're a quintessential institutional player. BNY Mellon holds or manages approximately $30 trillion. And so our clients trust us to keep that money safe and secure. But in the center of it is data and information. And when I think about data and information, it's really the lifeblood of any financial service institution. I mean, at the end of the day, what we do is we ingest data, we manage data, we analyze data, and then we distribute data. Those are the basic functions of a financial institution. And so in this interconnected world, our mindset really is that we are an extension of our clients, and that we don't think of ourselves as our closed system and we receive data and we send data, but rather we think about from the time a client or a client's client makes an investment decision or a trade, how the data flows through their systems and potentially third parties, coming into our systems, potentially moving to a counterparty, and then moving back out again. And in this kind of a world, there's really three characteristics that we think about. One is that as we become more and more of a technology company, we think less about our proprietary stack of technology and more about those intersection points. And so we build things using APIs, open source so we can put components together, and using the cloud, obviously, so we can have more of a connected system. Second is we really kind of view the lines as blurred between major financial institutions. And the institution who has a mindset that they're part of an interconnected network of technology and data are going to be the winners, less institutions that just think about themselves. And then in this kind of a world that's much more automated and much more real-time, security, trust, the intervention points around fraud or unethical behavior, those become even more important.
Amazing. So essentially what you're saying is this applies equally to all of us, and we need to start thinking about it carefully.
Yeah, I mean, at the end of the day, the institution is defined by, we service usually other institutions that then service consumers. And so that flow is continuous.
Very good. So I think if you remember in the opening video and some of the stills that I showed you afterwards, I talked a little bit about this concept of positive feedback loops and what happens when automated systems go wrong. And I thought before I invited somebody who's quite an expert on this onto the table, I wanted to show you this video which I came across, which is, for those of you who remember, in the US a few years ago, there was something called the flash crash. And the flash crash was where algorithmic trading systems in the US that typically were trading the S&P went into massive positive feedback loops and resulted in the market crashing. So what you're going to see here is, on the screen, you're going to see the S&P 500 as it drops. But what you're going to be hearing is the pit traders at the Chicago Mercantile Exchange who trade the futures and their reaction to this. So let's roll that.
We have seen some big paper sellers coming in. It all started out up above around 38 even here. Now, guys, talking about 25 handles of solid sell-side activity here, guys. 1 evens are trading here now, guys. 79s are trading. You got 79s trading here now. Once again, 78s are trading. 6s are trading. 76 evens are trading here now, guys. 75 evens are trading. 4 evens, 3 evens are trading here. 2 evens are trading.
So, as you can see, this is what happens when things go horribly wrong. And maybe to help us make sense of that, let me invite Amber Case to the table. Lovely to see Amber. Amber's a fellow at Harvard, at the Berkman Klein Center for Internet and Society, and a real expert in this field. So, Amber, you just saw this flash crash video. I mean, what can go wrong when you automate everything?
Yeah, well, I love this video because it is a great example of when things go horribly wrong, and it's happened before in the past. And the best thing to do is just stop doing anything, just stop completely. How many of you, raise your hand, are annoyed by random attention-grabbing beeps on your phone, or you try to get something done and something else happens in the way? This is what happens all the time. And we kind of think about, oh, well, there's this perfect future. We keep pushing it out. Now it's at 2020, where we'll have this perfect future in which we've figured everything out. We have all the automation. And as Mark Weiser from Xerox PARC said in the 80s, he said that the scarcest resource in this century is not going to be technology, it's going to be our attention. So how do we have technology that respects our attention and gets the things done that need to be done and free us up to do the things we need to do? Oftentimes we make these machines act like humans. They have these robotic voices that are incredibly annoying. We get stuck in parking garages because something tries to do the job of us, and we end up becoming more like robots. And in doing so, we forget that technology is really good at noticing patterns over time, and humans are really good at curating and understanding the context. And the more we automate systems, the more important that our human experience becomes. We don't want to automate hanging out with our family or friends. We want to have more time to do that sort of thing. So the idea of calm technology is that we have smarter people, not smarter devices. We have the information we need to make the decisions, but we don't have devices automating everything in our lives, because it's a symbiosis between humans and technology, not just technology doing everything for us. Because as you can see with that video, sometimes things happen, and it really becomes on behalf of the human to do something about it.
Well, thank you, Amber. I mean, I think it's safe to say that is it that we are not ready for this, or we will never be ready for this? Maybe just that one quick.
Sure. I think that technology has always been ready for us. We're just not ready for technology. I mean, a lot of times people say, let's do all these features. But as we saw with devices like Google Glass, you can't just throw all the features out there. Even when elevators came out, we had to slow them down artificially because people's eardrums were hurting when they went in the elevators. So the idea is not that humans aren't ready. It's that we have a metabolism rate. We can only metabolize one feature per season, and that's, as you saw with the launch of the iPhone. We had the iPod, and we got used to that type of interface, and then we had the actual iPhone itself with some apps. We couldn't make the apps, and then finally we had an iPhone with apps that we could create, and by that time people understood those new social rules, those new application features, the new user experience, so you can't just throw something on somebody automatically.
So maybe Doug, sticking to technology, I mean, you've seen technology drive, innovation, disruption in several fields. I mean, what can you tell us about your experience around that?
Well, I'd agree with Amber. I think it takes several cycles for the technology to be adapted. So when we're talking about predictive analytics and robotics, which we have some actually running in-house, it'll become the norm 10 years from now. So in the late 90s, I actually had a company that helped large companies figure out how to navigate the internet. And that was dealing, I call it interconnected 1.0. It wasn't the things we're talking about, but large companies had to figure out their expertise and then how to live in this interconnected world. And then in the early 2000s, I was in the stock market business. And back then, even in US equities, there were floor exchanges. And people talked about floor trading and electronic trading. Now people don't even call it electronic trading because they know in US equities and really global equities, all trading is electronic, and price discovery and execution happens in an electronic way. And then I had the good fortune to run a large government agency, the Internal Revenue Service. And I was recruited to do that under the guise that it's a large financial service institution. And one of our major focuses was to increase electronic filing to over 90% and to process all of the returns, business and individuals, real time that same day. And we shifted the mindset from one of forms coming in to one of managing data. And by doing that, dramatically increase the customer service and dramatically increase the compliance in the operation. But these things take time, and so I think the things we're talking about now, most people in the audience are working on it, and it's going to become, we'll look back 15 years from now, and everyone will have figured it out, and it'll become the new normal.
Great. So, I mean, look, we've spent a lot of time talking about where things go wrong because of automation, but maybe we should spend a couple of minutes to say when things go right. I mean, Amber, when do things go right with automation?
Sure. I mean, one of the biggest issues is that we're no longer dealing with finite systems. We aren't dealing with video games. We aren't dealing with a desktop world where we can pay all of our attention to the screen. We're trying to get something done between being in line for the checkout counter or trying to get on a plane. And oftentimes this doesn't entirely work out because there's captive portals, there's network connectivity issues. But there are some pieces of software that I really like that really abstract a lot of that complexity behind the scenes. You can think of Bank Simple, for example, as an application that abstracts away some of the complexity and kind of becomes this light banking app where you can see what's happening with your money, automatically categorizes it. But the most important part of this app is that if you get stuck in another country or you want to know what your last transaction is for your taxes, there's a small text message system within the application that you can talk directly to customer support. Customer support and user experience are their most important solution that they have within this application. And the other thing about this is oftentimes people will say, let's just redesign our entire system. In reality, you just need to call tech support and say, what are the biggest issues that you're dealing with? And elegantly solve a few of them so it's easier for people to use. Then you can free up your tech support with the same amount of resources. You can do a lot more. Again, these people shouldn't be solving the same problems again and again. There's another app that I really like called Acorns. Acorns just rounds up the amount of money that you have spent on something and it just invests that spare change. This is a kind of calm technology app because it just does something in the background for you. You're not really going to miss that change, but over time that will add up to something more significant. Again, these are kind of light banking and investment apps that get a next generation into these services without panicking them and overloading them with all sorts of terminology and technology. And finally, Robinhood is a nice system because instead of allowing you access to every kind of trade, it allows you to see things over time, invest money very quickly, and have your trades go through. And again, the interface is very elegant and makes a lot of sense.
So if I look at all of these applications, what they all have in common is that they're abstracting the complexity and presenting it to you as a user in a simple interface. I mean, would you say that's kind of the USP right across these?
Yeah, it's really important because behind the scenes, behind all these apps, there's all sorts of regulations and complexities. And especially with the company like Bank Simple, they've taken a significant amount of time to be compliant with those regulations while offering the simplest user experience, which means that takes so much time on behalf of them. We often reward people for building things that are entirely new. We don't reward people for having something with less code. I would like to update a piece of software and have it be smaller than before, to have it run faster than before. Unfortunately, every time we update phones and operating systems, there's more room, there's more power, and the software that we have fits that complexity. It grows to that complexity instead of being the minimum amount of technology to solve the problem. And this is where we get into a lot of issues with support and those edge cases that we can't predict, and that's why we need so much customer service.
So John, if you saw all of those, is that pretty much the ethos of Betterment when you put the company together? I mean, how are you thinking about it?
We thought when we started the company that financial services had been built by financial services professionals for financial services professionals with very little thought to what customers really wanted. And I, in my own personal investing life, was so frustrated with the options that were available to me. I just wanted a service that would manage it for me and do all the right things automatically. And I realized that wasn't going to come from the big banks or the big investment companies. And that's why I started Betterment, to start with what customers want and to think about things in an entirely different way. And if you think about what customers want, they don't want things like slightly more emerging markets versus developed markets exposure. They want to make sure that they are on track for retirement. They want to make sure that their kids are going to college. And we can abstract away some of the lower level details and give people what they really need.
Fantastic. So maybe just before we get into the next segment, we're going to show a short video from MasterCard. And I think it's a little bit around the same theme, which is how do you abstract this complexity to make it simple and embed it into people's lives? So let's cue the video.
Before I'm moving, I'm going. Connected. Ready for whatever life brings. Because I know Time matters. And my time is precious. I move through my day as simply as I can. No delays. No missed trains. How I move changes. Where and when. But it never slows down. MasterCard. Commerce for every device.
So Carlos, I mean, what you're showing in the video is essentially use cases for contactless payments, and contactless payments is a reality today, right? So how do you think we're going to evolve this kind of technology in a world of Internet of Things?
Well, look, I think the beauty of contactless is that it shows that the short-term future of money is just better money. It's faster, it's safer, it's simpler. It's the extraction of the complex. It's the whole innovation spectrum. And what we see is that here's something that the consumer chooses how they want to pay, and they do it quickly. Today in Australia, 70% of transactions are contactless. But this is not an overnight success, right? Guarantee Bank in Turkey first started this, I believe, in 1999 at scale. So everything around NFC and the pays and all that took 16 years to get to where they are today. But I think the key thing is, as we evolve to the Internet of Things, it's a recognition that there will be many small transactions, many small decisions, and that simplicity and interoperability that are built into contactless have to extend through to the Internet of Things.
Very interesting. So let me take a slightly different different tact here for a second. I mean, we've heard a lot from both you, Carlos, and from you, Doug, around why trust is so important, right? We touched on this concept of trust. And so maybe, John, I mean, why should we trust an institution like Betterment, given the relative size in the asset management market? I mean, what's the AUM of Betterment? And, talk us through that a little bit.
I love the question of trust, because there was an Edelman survey this year of consumer sentiment around what industries do they trust most. And out of a dozen different industries they surveyed, number one was technology, and the last one was financial services. People inherently distrust financial services, and technology is an answer to that, because technology brings transparency and reliability, the confidence that people are looking for in things. And as a result, Betterment is the fastest growing investment advisor ever. We have grown customers and AUM faster than anyone in history. So we're now 6 billion and 200,000 customers after only 6 years in business.
That's amazing. So again, maybe just to cover off sort of various aspects of where we started out, Amber, you have some very interesting and strong ideas around the whole distributed computing paradigm, which is obviously at the core of the Internet of Things, as we talked in the film about how that works, the interconnectedness, and individual devices making decisions based on sensor-based feedback. Can you talk us through your thoughts around that?
Sure, yeah. If you look at the evolution of computers over time, you see that we've gone from, on the left side of this graph, many people per one computer. You would have to go to your local college and university to even get access to a PDP-8 or something like that. And then you had these small workstations, and then we went down to desktops where there were a couple people per computer. And now we're going back up to storing way more data outside of us in these remote server racks. And now we have mobile that's a little bit part of it, and we saw in the MasterCard video, we're kind of having this technology get a little bit closer to us. For instance, a lot of people talk about having mobile phone technology that can get you through a gate to get into the transit station, but battery life is an issue. What happens if it's incompatible with your particular phone? If you have a bracelet, it's pretty simple. We see this in South Korea. We see this in a lot of different places. So the issue behind this is, if we have a lot of personal data and we store it with ourselves first, we have these phones that are basically personal servers, and we distribute this, suddenly we have less issues with security because we can have what's private with us near to us. It's not like we store a birth certificate somewhere else. We usually store a birth certificate, a deed, a title in our actual house. And so if you do as much processing on the device itself, when things go wrong, like network connectivity goes down, you still have some resiliency, you have some redundancy. I shouldn't have to be a system administrator to live in my own home. With this whole Internet of Things, I shouldn't have to go through the web to turn on and off the lights in my house. And similarly, if I go to the doctor, if I go to my financial institution, I should have that data stored with me at all times, and then I should allow the institution to have access to that for a period of 24, 48 hours in order to add data to that I then get added to my file. And that way, if somebody hacks into these systems, they only get a piece of that data for a limited period of time. You're not getting this attack that takes all of the data because it's with you. And so you'd have to actually hack into a particular person's phone in order to get that data out. And as you know, a lot of the applications on your phone don't work in airplane mode. But what happens if you don't have access to that? What happens if you need to change providers on banks, on doctors, on anything? You can't just port your data over and bring it with you.
But just on that, aren't you creating a single point of failure in a system like that?
Well, there's right now there is a single point of failure because you have all these things stored in one server, and so if somebody attacks it, they're getting all of that data out, right? So the single point of failure would be, I guess, if your phone gets taken, you should have a backup redundancy. I mean, in engineering, which we're supposed to be doing, you should have redundancies. You should have data stored in a number of different places. You can store a copy in the cloud. You can store a copy on your phone. You can store a copy on your computer. You can have a personal server in your house. But right now, we have all of our data far away from us in all these different services. And very few of us have a personal wiki or a personal blog or some sort of encrypted file that actually stores our data. And so we have to call up these providers, through the web to actually get our data back. Same with quantified self-devices. You can buy all the quantified self-devices, but you're actually buying your data back at the end of the day. And really, the whole point of those is to take what's invisible and turn it visible, so you can actually make decisions about your life and see things over time.
Okay, we're going to come back to this in a second, because I think it's a very important topic around ownership of data and buying it back. But before we do that, I guess, Doug, you're going to be disagreeing with the single point of failure point, especially in the institutional market. So what do you think about the characteristics of interconnectedness, when it comes to the institutional market?
Yeah, look, there's a few characteristics, and I talked a little bit about them before. One is the blurring of the lines between players and viewing yourself as part of a data ecosystem. The second is really focusing on the connection points and how you're ingesting and moving data. The third is probably using robotics, artificial intelligence, predictive analytics, and then there's security and trust. And let me give you two examples. One's live in production. One is things that people are thinking about and working at. So we have a client that's a pension fund, or lots of pension funds. They have asset managers, so they might have 100 or 200 asset managers that they give money to manage their assets. We custody and account for those records. And on a daily basis, we need to reconcile all of those databases, making sure the assets are all in one place and account for the money at the end of the day. We now have in production robotics that actually reach out to the asset managers, pull down the data, they can compare the data. Our client, the pension fund, is linked into us via an API, so they can then consume the data. And this is all done on a real-time basis. It's better client service. It's more secure. It's totally audible. People don't make mistakes when they're doing those kind of comparisons. That's an example of using kind of automation and robotics and APIs to have an interconnected system where each person used to just be sending files back and forth, and lots of humans were comparing it. The second example is think about payment fraud. And imagine a world where a instruction is sent to us, and based on either the sender or a data attribute, and it's been developed, algorithms have been developed using artificial intelligence and predictive algorithms, that payment is stopped. And in real time, because we're connected with an API with the sender, the information goes back to the sender with information embedded into it about why it was stopped. That person has artificial intelligence and can now look at that payment type and other payment types and have predictive patterns, figure out, is it a false positive, so that actually we meant to do it and it wasn't coming through the system wrong, or they didn't. If it's a false positive, the payment actually goes through in a matter of milliseconds or seconds instead of an hour of people making calls back and forth. If it's not, and it really is a fraudulent payment, that pattern can be recorded, distributed out to a global network of institutional players who all can embed in their system the new pattern that's put into their own ingestion systems, and everybody's running artificial intelligence and looking at that pattern versus other things that are coming in. And within a period of 5 seconds, the global financial system can have detected a fraudster and a malicious pattern, put it into their systems, and it'll be stopped once and forever. Now, that isn't here today, but those are the kind of things that we're working on, which is much different than someone hacks into a system, they steal money, you discover it a month later, you send messages out. There's a consortium of people who talk about it and try to figure out how to code their own systems. That's the kind of world we're talking about working towards.
I mean, maybe, John, coming back to this whole retail versus institutional discussion. I mean, Doug's touching on some of the systems, resilient systems you need to build for large institutional markets. I mean, you guys are predominantly in the retail market. I mean, do you kind of agree that the bar for institutional markets is significantly higher than for retail markets?
There's no question that the volumes of money moved in institutional players is bigger than the average retail transaction, and that usually means that it gets more scrutiny. You do more checking on a $200 million transfer than a $10,000 transfer. But in some ways, the bar for retail is higher. There's more regulation around retail financial accounts than around institutional. We just had the DOL fiduciary rule in the US talking about all the scrutiny and rules that need to apply to retirement accounts for individual savers. What an individual investor can invest in is a smaller set of things than an institutional investor. It's more highly regulated. And in some ways, we look at the history, or at least the modern history of financial services, of taking institutional products and making those accessible to the mass market, taking those things that only high net worth individuals have had access to and making them available to all. And that's what we're doing. We're taking some of the best technology and services that had been really hard to get because they were too expensive or too limited in supply, and making them accessible.
Okay, very interesting. So, Carlos, maybe let's switch tact a little bit and talk a little bit about one of the things we touched on at the beginning, which was, and what you said, which was, the concept of money itself seems to be changing. Standards actually themselves need to evolve. Is there anything else that's shaping the future of money for you? And how does this new reality shape actually the strategy of a big global company like MasterCard?
Sure. Well, when you think of the future of money and data being a component of it and the Internet of Things, there's an assumption that everybody can access that. There's a view that everybody has a digital identity. But for everybody on the Internet, there's one person not on the Internet. And we estimate that there's about 100 million people in Western Europe who are unbanked, 70 million in North America. So there are gaps in these individuals' ability to access this future money. And money today works for everybody, the rich and the poor, or the very rich and the not so poor. But so the question becomes, how do we set our work now at MasterCard to build that future and ensure we're available to everybody? And our CEO has talked, extensively about the Internet of Everything requiring the inclusion of everyone. And we have a target of, of adding 500 million people to the banked around the world. We have, programs throughout the world, 600 odd programs in 50 odd countries. And the view is that if we don't do that today, we're going to be missing part of society and also missing an opportunity to grow.
I'm glad to hear that. Certainly part of my current investment thesis is all about going after the large swathes of population that are unbanked or underbanked. So that's certainly the future. So maybe just again switching tack to get Amber, we talked a little bit at the beginning, and you may remember in some of the stills I put up some pictures of white blood cells, and the reason behind that is, bizarrely enough, I'm an immunologist by training, so I majored in immunology and genetic pathology, and so I'm always fascinated to see people who agree that the best adaptive systems are actually based off the immune system. Can you give us some thoughts on how you think about that?
Sure. As we saw in the plenary today, the idea that in the industrial society we had to deal with all sorts of weird issues that happened where we were living in cities packed together and viruses would spread incredibly quickly. We have the same thing going on right now with our technological space. And it's not just having a hacker come in and spread a virus, it's also the social engineering element as well. I mean, there are so many easy ways to just call the financial institution and say, hi, I'm a security expert, I'm going to come in next week, I'm with this company, print out a fake badge, go in and have access to the entire system. It's not really a big deal. And that's kind of the issue, is that if a cold affects us as humans, we don't just die, right? We have a system that's developed over time to make sure that we don't. We have antibodies, we have this resiliency, and that's evolved over time with us. And right now we have incredibly brittle Titanic-like systems that if you get in one place, you can take down the entire system, which is absolutely ridiculous. Right now it just doesn't make a lot of sense to protect these systems against that, because people are still in denial of the fact that everybody's going to get hit. It's not if, it's when. And security people have been talking about this since the 1990s. And of course, the stakes are higher and higher each time. But if we make systems that are more resilient and organic, as sociologist Emil Durkheim said, as societies progress, they go from mechanical to organic. And now we're in a more organic future. You can't just release a product with no research and not develop it over time. We have to kind of develop with respect to these threats and expect them, welcome them, and be okay with the fact that they're going to happen. Instead of being more defensive, we need to be more proactive. If we look at them, not necessarily because they're not positive, but if we look at them more with the idea that, yes, this will happen, we can start to reward people that penetrate systems and show us where the issues are, possibly hire them, do a lot more testing before we release something, and make sure that we have liability involved. I guess there's one last thing I'd like to say. There was this application, this Internet of Things, which was a cat feeder, and the cat feeder would allow you to say hello to your cat over like a Skype type of situation, and you could feed it, and it would go on a timer. So a lot of people signed up for this application. They got it, they shipped it to their house, and they went out of town for a month, and they didn't give anybody a key to their house. And suddenly, the network goes down, the centralized network that this cat feeder's on, and we get this new kind of Schrodinger's cat. And the Schrodinger's cat is where none of the users knew whether their cat was alive or dead. Now, this is a silly example, but the idea is if you have humans connected to the system, if you have financial records and you don't know where those records are, you don't know whether somebody is alive or dead, who's responsible? There's not a lot of legislation there for what happens when that goes wrong. So we're seeing these smaller kind of cute, funny anecdotes that we can talk about, but when it's your entire system that's having this problem, it's a really, really big issue. So having the idea that this is going to happen is really, really important, and working with people outside of 9 to 5, and working with people outside of your industry on this is incredibly important.
Great. I mean, look, that sort of makes me think about the fact that isn't a adaptive system that in effect is automated dangerous in its own right, because then you're getting back into the realms of ceding control to something which you have, you just don't know where it's going to go.
Yeah, I think the term that we've forgotten from the 1940s is cybernetics. You have a feedback loop that's part human, part machine. It's kind of logarithmic, it's kind of algorithmic. And I don't like the term artificial intelligence because it implies that there's no humans. I rather like machine learning because everything that we program is programmed by people. Most every website is programmed by something. Every programming language was created by a person. And so this is the issue where we keep forgetting. We think, oh, technology is outside of humans, but in reality, it's created by people. So this is something where you evolve it over time, slowly back and forth with a person and a computer and a person and a computer, and you do these small incremental steps. Like, let's say that you want to use a blockchain for something. You can't just release that all at once. But if you do these A/B tests and slowly have it emerge into a system, then you can see whether something's going to go wrong or right. You can isolate it. You can have systems shut down if something goes wrong, and it's not going to kill a lot of people or cause massive liabilities. And the idea is often that people want to, okay, we'll just do this new thing because it's really exciting, without testing it out in small spaces first. I mean, nature, you can't just suddenly show up with a rhino out of nowhere. The rhino will get killed, right? The rhino takes millions of years to evolve, with respect to its environment, with respect to the changing environment. And what we have now might not work in the future, but our products need to be flexible enough that when we get to that future, we'll work well with that ecosystem.
So Doug, let me ask you a question. Would you trust your entire investment portfolio completely automated in John's system, just coming off to this point about?
John asked me that same question last night. Look, I think the future is going to be human judgment and smart, motivated, trustworthy people working together and automating as much as they can. And there's certain things like math, which is a lot of financial services, or a lot of what John's talking about, or at least my interpretation, that machines can do just fine, and sometimes better than humans.
I'm an optimist. I mean, I think all of this stuff is for the good. I mean, if we were afraid of technology, we'd all still be in caves or working in the fields or whatever. And we have agency in how the technology here evolves. And just like even with self-driving cars, we're still going to have our favorite restaurant. We're still going to know where we want to go and tell the car how to get us there. And all this technology doesn't take away that agency from us. We're still the masters of our lives, and it's one of the many tools that we use so that we can do what Amber said we really want to do, which is spend more time with our friends and family, or work on our passions, or whatever it is we most want to do, which typically isn't manage my finances.
Carlos, where do you stand on this one?
We've been having this debate too. I'll test and control a small portion. It works.
So you're gonna you're gonna take a little piece, see how it goes, and maybe back test it.
I need some resilience in the system.
You need some resilience. So talking about old, BNY Mellon's like 232 years old. Should people around here be super surprised that you're thinking so dynamically about innovation?
So BNY Mellon was founded 232 years ago by Alexander Hamilton. And right after the Civil War, BNY Mellon actually, or Bank of New York at the time, issued the first government bond to help pay for the Civil War. And so I think of it a little bit like Hamilton the musical. So if you think about Hamilton, until a couple of years ago, everybody thought of a guy with a wig and one of the founding fathers walking around with a quill pen. And now when people say Hamilton, they think funky, hip hop. It's the whole reincarnation. It's the soundtrack that my preteen daughter listens to more than any other ones. And BNY Mellon, similar to what I think Amber was talking about, these adaptive institutions, now really views itself as a digital service and technology company that just happens to have a balance sheet to facilitate business with our clients. And so, I think any financial institution that, whether it's one like ours that has $30 trillion of assets and is built on a foundation of trust, needs to figure out how to harness the power of technology and data to drive the business.
So that's a very interesting point. So do you think that all these institutions in this room should reinvent themselves as essentially technology companies with a balance sheet?
I think most institutions at Sibos and most institutions in the industry that I talk to all are trying to figure out how to be a digital company and how to harness the best of the digital world and how to be more interconnected, but also to stand by their own virtues and the things that made them great in the past.
Okay, great. So let's go back to the question that I started with at the beginning, and if I can get everybody to remind everybody about their little voting. We're going to put the question up again, ask you the same question again, And it's just curious to see if actually we've changed any viewpoints here. So I think when the clock starts ticking, you can click. There we go. So go ahead and vote, please.
One person.
Hey. So we moved by 0.7%. Not a lot. You see that nothing much changed. So I think people have their set. I mean, what's your thought about? We haven't gone around asking everybody here. What's your thought about this question?
So I'm not sure if we were trying to move people in one direction or the other. They're both important, and I think the point is. Data and information has a lot to do with your money, but as my colleagues would say, and will say later in Sibos in a presentation at InnoTribe, it doesn't start really with data. The best advice, the things that we need in our financial lives, start with human intuition and designing an appropriate system that helps us reach our goals. That's what finance is about. It's about helping people reach their goals. And that's what technology can help us do better.
Carlos?
Okay. At MasterCard, as a company focused on technology, we think that we'll make money better via data.
Doug?
I think underlying all data in the financial system has to be some sort of collateral or asset. And so I really think of data as a means to account for and move money. And they're both incredibly important. But if the older you get, I think the more you'd pick data over money. But if you're young, I'd invest in data and try to make some money along the way.
Amber, you agree with that, or?
Yeah, I've done 2 startups. I did one in college, and then I did one post-college, and they were both based on research. I saw that I used data to figure out what wasn't being serviced in the market, and then built startups based on that, and then I got money. So technically, I use data to get money, but now money to me is a way to make use of that data and make more of it so that I can take advantage of other opportunities. But the data was just a nice trick to get to the place that I wanted to go. So I guess I'm going to have to say data.
Well, I'm glad you said that. I mean, I think 2 or 3 years ago at Future of Money, I did a similar video, and I said data is the new oil, so I'm just happy that people are still there. So I think we're out of time. I wanted to thank all our guests today for taking the time and sharing their thoughts with you. I truly hope you enjoyed today's session. As we say, we try to think about where this industry is going to move in the next 3 or 4 years. So hopefully this gives you some thought for the future. And thank you very much. Give a big round of hand for our guests. Thank you.
Nice job.
Sorry.